Good afternoon, welcome to Market Wrap number 174. Stuart Williamson here at the helm. This week, 35-year mortgages on the rise. Bank of England increases stress testing, but potentially sees no threats. Knight Frank, residential rental forecast, what's ahead for us for the next 3 years. And Labour Party conference, what controls do they plan to bring in? What does the Labour Party think it'll do if it gets into power? So the Bank of England's alarmed at a rise of 35-year mortgages. And you can imagine why that is, because people are trying to cut the costs, of borrowing and how much it costs to live with the cost of living crisis. Bank of England says that homeowners taking out mortgages of 35 years or longer has jumped as borrowers try to offset the impact of high interest rates. The bank warns. Threadneedle Street signalled yesterday that it was watching the developments in the mortgage market closely as homeowners look for ways to limit the steep rises they face in monthly mortgage costs. It said that the share of new mortgage lending on terms of at least 35 years had climbed from 4%, 4% in the first quarter of 2021 to 12% in the 3 months to ending in June. In addition, a small number of owner-occupiers had moved on to interest-only mortgage deals as a way to limit monthly payments. Again, we're seeing it offshore, not the increase in the mortgage size because people have got more disposable income, but people are looking at interest-only as a bit of a hedge in the short term. Bank of England goes on to say, whilst longer mortgage terms and other forbearance measures could reduce pressures on borrowers in the short term, they could increase debt burdens over the longer term. This was in its latest analysis of the financial stability risks facing the UK, which came out this week. And what did the bank do? The bank is calling for tougher rules on the 250 billion sterling money market funds industry. Not entirely sure why. It announced that its annual stress test of Britain's biggest banks would gauge their ability to withstand a broader range of hypothetical economic crises. And it signalled that the annual stress test could be widened to include more lenders. So basically they're worried about stress testing not being comprehensive enough and some banks escaping it. So the bank cautioned that the full impact of high interest rates had yet to be felt by all borrowers. Although the base rate has been lifted from a record low of 0.1% in November 2021 to 5.2%, as you know, with the bank trying to combat rampant inflation. Well, rampant has gone down quite a bit. It forecast that the share of households with high debt servicing ratios was expected to continue to rise and would reach 2.5% by the end of the year. Now, if you compare that to where it was at the global financial crisis, that's well below. It's only 2/3 of where it was, which was 3.4% in 2007. So it goes back to echo the point that's been there all along, that we're not in the same situation as we were when the global financial crisis was around. We're in a far better position. The banks are stress testing better and are even increasing it now. We haven't got the same self-certification mortgages. The bank did say there's been an increase in households using other forms of consumer credit, such as credit cards, to make ends meet as they wrestled with inflation, as well as higher rents and mortgage costs adding to that. They go on to say this could lead to greater debt vulnerability for households in the near term. However, despite the challenges facing the economy, and this is the major point here, the bank concluded that Britain's banking system was resilient and could continue to lend to households and businesses even if the environment was substantially worse than expected. So it's a positive outcome. Okay, now I thought we'd look at Knight Frank very quickly, look at their housing rental forecasts. They brought out a new report this month. They start off with sentiment will become more positive in the UK housing market as the economic picture improves, but a general election is looming next year, and that is the elephant in the room. They say that the last 18 months have been very trying for property investors. No surprise when mortgage rates are more than 3 times higher compared to they were 3 years ago. I didn't realise it was quite as bad as that, but I suppose it is. It was 1% and now it's 5.25. The cost of borrowing has risen after an exceptional period following the global financial crisis. The rates hovered close to zero for more than a decade after the global financial crisis. Fair enough. It's a return to normality where the journey rather than the destination has been the problem. Anyone buying, selling or remortgaging property in the last 18 months has faced market volatility caused by the mini budget and inconsistent inflation data. The cost of borrowing has lurched erratically, and I know some of my poor clients have had 3 or 4 offers offered and then rescinded within a week. It's very poor. The cost of borrowing has lurched erratically, sentiment has been eroded, and this has put downward pressure on house prices and to a more noticeable extent transaction volumes. And it has. Sentiment is where we're at. People are feeling quite negative when there's really no need. 5-year swap rates have dipped below 5% in September, which everyone's going, hoo-ha, well done. But 2 years ago, they were 1%. However, some stability's come in now. The Bank of England has kept it at 5.25%. Doesn't seem to have, it seems to have reached the top. And so Knight Frank are now saying they're updating their house price forecast to reflect these recent changes. They do expect house prices to continue to fall. The volatility that's gone on over this summer means that they expect house prices to continue to fall this year, probably by up to 7% in a general format across all the UK. So that's mostly in the south, getting up to about the Midlands. So it's mind the gap really, 2 different parts to it. Next year they expect house prices to level out, perhaps with a small fall as the economy stabilises. And speculation turns to when the next rate cut will come. Improving the sentiment is the key. You've got to feel positive about it. The number of people moving from lower fixed rate mortgages to floating rate mortgages will not fall in 2024, but the backdrop will not be such an unpredictable flow of economic data and so many rate rises. So the backdrop is more positive next year. So they don't expect it to be the prices to fall, which is across the UK, mostly in the south though. But the general election will suppress demand. People don't like buying in a general election year. A change of government presents a higher risk to prime markets in particular, but higher rates of tax around property and wealth in general has been the global direction of travel for more than a decade for property. We're paying more tax in the UK now, if you're based there, than you have since the Second World War. Rental forecast, much more positive if you are a landlord. Some landlords have left the sector in recent years because of the mounting tax burden and increased red tape, but those who are still there are enjoying a bonus sort of period. Across the UK, annual growth stood at 5.5% up to August in rentals. That's across the UK. In the south, it's quite flat. In places like Scotland, it's nearly 12%. But this 5.5 is the highest rate since records began, as the wider UK rental market grapples with supply-demand issues. Demand for rented homes continues to be driven by multiple factors. The strength of the labour market and job creation is the key driver, as well as high mortgage rates, which are keeping more would-be buyers in the rental sector. Nationwide data points to a 25% fall in leveraged first-time buyer numbers in 2023 compared to pre-pandemic levels. At the same time, the data from Rightmove suggests that rental listings are more than 50% lower than they were in 2017-2019. The result is that the current supply-demand imbalance shows no sign of reversing. Therefore, expect rental prices to continue to increase for the rest of this year and then further up for 2023-2024. They're expecting overall 6.5% next year and 5% the year after. So overall about 23% rise over the next 3 years in rents. That is big if you're a landlord. Very poor if you're not an owner. Okay, now, Labour manifesto. What are they saying at their party? It claims to be, going forward, the party of home ownership. What does that mean? Is it rent controls? Is it new right to buy? New social housing initiative? We don't really know. The New Statesman reported this week that following the Manchester Labour Party conference, the Shadow Housing and Levelling Up Secretary Lisa Nandy delivered a speech setting out the broad principles that underpin the party's view. As ever, as I can see it from my reading, it's vague and wishy-washy. Politicians don't want to be nailed down to anything. Nandy doesn't believe there's a single solution to the housing crisis and identifies different interventions for different sectors of the market, whether renting, development or council housing. But the overarching idea was to tilt the balance of power from land speculators to councils and developers. So how will the party do that? One policy they're saying is they'll scrap the requirement for councils to pay a premium on land to account for the value added from a potential development. The Labour Party source pointed to the similar policy in France, Germany and the Netherlands, where there are no great examples of success either, really, the Netherlands in particular. Another is to force developers to identify land to build on rather than waiting for them to volunteer it. Elsewhere in the speech, there were familiar attempts to signal that Labour is no longer scary and radical, and they ruled out rent controls. So that's quite a big thing, because in Scotland they've introduced it and it's grim up there. But Nandy did make the case for an activist state. An example the statesman quotes is, "A broken market and an absent state is the worst of all worlds. A state of affairs as fundamentally anathema to the conservative tradition as it is to socialism. We will tilt the balance of power back to first-time buyers and use the power of the state to help them make the leap into home ownership." Statements such as that give not Mr. Keir Starmer, the opportunity to claim Labour is the party of home ownership, particularly when Rishi Sunak is silent on the matter, and he has been, wishy-washy at worst. So that's it. Thank you very much, Market Wrap 174. Thanks for watching. Knight Frank saying mind the gap. North is still going up, the south is falling. Rents continue to rise. That's got to be good for landlords. Bank of England increases mortgage lending controls, and those costs will be passed on to consumers, so look out for that. And the Labour Party says it will not introduce rent controls. And that's a positive, because that is, I think, it would be a potential nightmare for the market. So thanks for watching. Do like, subscribe if you can. Share it. Thank you very much. Cheerio. Bye-bye.